Check your charts right now. Bitcoin is painting a textbook bear flag on the 4-hour time frame, sitting exactly below the Ichimoku Cloud, and half of crypto Twitter is already smashed short waiting for a collapse to 70,000. But if you look at the daily close, you will see why this is a massive liquidity trap. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end, because I am giving out 3 exact entry and exit levels that will save your positions before the volatility spike hits. Here is your instant market verdict for the next session. The bias is a range-bound compression with an upside resolution bias on the daily time frame, completely contradicting the 4-hour bear flag fear-mongering. We are fading the breakdown unless the S&P 500 collapses. Write this number down. The invalidation level is 79,759. If we get a daily candle close below 79,759, the entire multi-week bullish structure shifts to a bearish distribution. Until then, the dip is a buying opportunity, but you must be surgical. Technical deep dive is the first we look at. Let's zoom out to the weekly chart to understand why the ground is shaking. This is where the architects play. We are consolidating above the weekly MA20, which is sitting around the 75,400 region, and the weekly MA60 is sloping up sharply from the 68,000 handle. This is critical because institutional position traders view any touch of the weekly MA20 on Bitcoin as a generational long entry. The weekly MACD is still positive, but the histogram is flattening, which explains the range. We are not in a bear trend. We are coiling energy for the next leg. On the daily chart, the picture gets clearer and scarier for shorts. The 200-day moving average is sitting right here at 78,900, acting like a brick wall that buyers just successfully defended. Price is stuck between the daily MA20, which is dynamic resistance near 82,100, and that MA200 floor. The daily MACD is attempting a bullish cross below the zero line, which tells me momentum is trying to flip, but we need one strong catalyst candle. This is the battleground between the bear flag and the trend. Now, let's drop to the 4-hour chart where the trap is set. The Ichimoku Cloud is bright red above us, ranging from roughly 81,300 up to 83,700. Price is hugging the lower edge of the cloud, creating this bear flag pattern. I see the volume profile thinning out inside the flag. This is a classic spring being compressed. Support sits at 79,759, right at the flag's lower trend line. Resistance is the flag's upper boundary at 83,279, coinciding with the cloud top. Here is what most traders miss: the negative divergence. On the 4H MAC that started yesterday is already being absorbed by sideways action rather than a sharp price drop, hinting at hidden demand beneath the flag. Then on the 60-minute chart, we are seeing a series of higher lows relative to the RSI, even though price is flatlining around 80,700. This is a short-term bullish divergence that will trigger the first wave of buying, and this is where the cross-asset narrative kicks in. The risk asset shadow is dark right now. The S&P 500 futures are grinding higher, holding the 50-day moving average, and the correlation between Bitcoin and the S&P remains historically tight. The funding rate on major perpetual swaps is neutral, even slightly negative in the last few hours. This tells us the retail crowd is actively shorting this bear flag, providing the jet fuel for a short squeeze. We cannot look at Bitcoin support levels in a vacuum. If the S&P breaks higher, Bitcoin's bear flag fails violently to the upside, no matter how scary the Ichimoku Cloud looks. The link here is simple. Risk appetite in equities is the tide that lifts Bitcoin, and right now, that tide is not receding. Connecting the last 24 hours of news to your price action right now is simple. The headline screaming Bitcoin below Ichimoku Cloud as bear flag forms is the perfect narrative to trap late sellers. We didn't get a fundamental macro catalyst for a crash. We got a consolidation following peak profit taking. The ETF flows have been relatively muted but not net negative enough to justify a trend reversal. We are seeing a holding pattern where spot buyers are absorbing minor ETF outflows. The geopolitical heartbeat in the oil market is relatively calm, which removes inflation panic, and gold is actually slightly bid, signaling uncertainty but not panic. The bond market is the key. Real yields are stable, which historically removes the pressure cap from Bitcoin. For the 1 to 2 week directional lean, I am leaning bullish breakout of the cloud as long as S&P 500 does not lose its 50-day moving average. The exact event that invalidates this thesis is a hot PPI print this week that sends rate cut expectations to zero. That would kill the S&P, spike the dollar, and drag Bitcoin below the 79,759 brick wall. Until then, treat this bear flag as a reloading pattern, not a distribution top. Most people will click off now, thinking they know the direction. But this is where money is made. Keep watching. I am giving you 3 specific battle plans. Strategy 1, the sniper, is the conservative pullback long setup. You wait for the trap to spring. Your trigger condition is a 4-hour candle close above the Ichimoku Cloud resistance, which is exactly 83,279. You do not buy the flag. You buy the confirmation of the failed breakdown. Once that candle closes above 83,279, you enter long. Your stop loss goes below the recent consolidation swing low at 80,200. That gives you roughly 3% stop distance, but the logic is that if we fall back into the cloud after breaking out, the breakout was a fake out, and you want out. Target 1 is the daily resistance at 88,500. Target 2 is the psychological 92,000 round number. The risk-reward ratio on this setup is approximately 1 to 3 to target 1, and 1 to 5 if we run to target 2. This setup is voided if Bitcoin fails to break the cloud and instead closes a 4-hour candle below 79,759. That is the hard invalidation. Let's see how aligned we are. Type your Bitcoin range for tomorrow in the comments right now. I am reading them and looking for consensus on whether we break the cloud or the flag first. Strategy 2, the active trader, is the momentum breakout long setup. This is for those who want to catch the move before the cloud break, but you need a catalyst. Your entry condition is a reclaim of the 4HMA20, which is dynamically moving around 81,400. If price rips through 81,400 with a bullish engulfing 1-hour candle, you enter immediately. Your stop loss is surgical, placed just below the intraday support at 80,500. This is a tighter stop, roughly a 1% risk. Your first target is the cloud resistance at 83,200. The moment target 1 is hit, you sell half your position. Then, you move your stop loss to your entry price, creating a risk-free runner. The trailing stop rule on the remaining half is simple. Trail the stop by the 20-period moving average on the 30-minute chart. If a 30-minute candle closes below the MA20, you exit the runner. This lets you exploit the short squeeze without needing the cloud to fully snap immediately. Strategy 3, the Aggressor, is the counter-trend mean reversion short setup. This is playing the bear flag logically. And you better respect the risk here. Your entry condition is aggressive. You short the rejection of the Ichimoku Cloud edge right at 81,800, but only if Bitcoin wicked into that level and immediately reverses with a bearish engulfing 15-minute candle. This is strictly a range top fade. Your stop loss goes above the 4H swing high at 82,500. That stop is your shield against the S&P 500 ripping and spot buying taking out the cloud. This is a counter-trend trade, so your targets are tight. You are targeting the flag support at 79,800, and you take profit entirely there. Do not hold this short hoping for a breakdown. This is mechanically fading the range edge. The warning here is explicit, only for those who can handle a sharp stop out and manage risk aggressively. If the S&P 500 opens green and rips through session highs, this short is dead. And never risk more than 2% of your portfolio per trade. No positions held through the CPI or FOMC minutes releases. And remember, stops are non-negotiable. If 79,759 breaks, cut the longs so the most critical level for the next session is not the cloud. It is that daily support at 79,759. Lose that, and the bear flag wins. Hold it, and we obliterate the shorts. Tomorrow we are laser focused on the PPI data and whether the S&P 500 can sustain its rally, which will be the catalyst for this Bitcoin breakout or breakdown. If you want the full breakdown on the S&P 500 and the US dollar index divergence right now, that video is live on the end screen. Contango is shifting, and the liquidity tide is turning. Smash the like button if this analysis gave you a clear plan for your day. Subscribe and hit the bell for daily coverage on these 8 critical assets. I analyze the traps so you don't fall into them. I'll see you in the next one.